Welcome to our discussion of Chapter 6, Merchandising Activities. So up until this point, the kinds of companies that we were focusing on were service companies. Remember, we've talked about the recognition of revenue. For that to happen, we either need to provide a service and or provide goods. So far, we've just looked at the service side of things. What would that look like for a service-based business? But in this chapter, it's all about merchandising and some of those transactions involved with merchandisers. So what is a merchandiser as opposed to a service company? Well, remember, a service company is a company that provides a service, such as a landscaping service, a cleaning service, anything that you can think of where a service is being provided, not necessarily a physical good being provided in exchange for cash or the promise of cash at a later date. So with merchandisers, they don't necessarily, it's not to say they can't also provide a service, but the main idea behind a merchandiser is that a merchandiser purchases inventory, then sells that inventory for a profit. Okay, so the idea is purchases inventory, then sells that inventory for a profit. So that's the main idea behind a merchandiser. Another name for this would be a retailer. So merchandisers have inventory accounts. Okay, so these are the accounts that keep track of how much inventory the company has. So inventory accounts, these are considered assets. They go on the balance sheet, but more specifically, they are considered as part of our total category for current assets. So along with things like supplies, cash, and accounts receivable, inventory is also considered a current asset. Inventory accounts are also part of the operating cycle for a merchandising business. So this is what the operating cycle for a merchandiser would look like. So operating cycle, but specifically for a merchandising business. So let's see what that would include. So I'm going to write it horizontally to show that cycle, that operating cycle. So first we take cash and we use that cash to purchase inventory. And that inventory, once we sell it, is converted into an accounts receivable. And then eventually we obviously hope to convert that accounts receivable back into cash. Now it's also possible that you take that cash, you purchase inventory, but that the inventory is immediately sold for cash and immediately converted into cash. It's possible that there's no accounts receivable involved with some of those transactions. So what are some examples of common merchandisers that you might have heard of? Some examples that you also see in the PowerPoint would be companies like Lowe's or Home Depot. Think of Target or Walmart, Macy's, JCPenney. Those are examples of merchandisers. They purchase inventory from wholesalers, and then they resell those products to the end consumer. So that's what a merchandiser or retailer is. They purchase inventory, they purchase product from a wholesaler or from another source, and then they sell those products for a profit. So that's the purpose of a merchandiser's business, is to sell product. Okay. Now, what about a manufacturer? How is a manufacturer going to be different from a merchandiser? So the main difference between a manufacturer and a merchandiser is that a manufacturer makes its own products, where the merchandiser has to buy the products it sells, where a manufacturer makes the products that it sells. Okay, so the difference here is they make or manufacture their own products for sale. Okay. So the manufacturer's operating cycle, it's going to be similar to the operating cycle for a merchandising business like we see up here, But the manufacturer's operating cycle is going to be longer because why? Because instead of purchasing inventory from other sources, they make their own inventory and they have to go through an entire manufacturing cycle / process to get those products ready for sale. So an example, let's try and illustrate that here. So we take cash. Cash is used to purchase raw materials, which is an inventory account that you guys will learn about in accounting for. Raw materials, labor, and manufacturing overhead. And then those raw materials, labor, and overhead is that goes into the work in process account, also an inventory account. And that is moved over, we'll go down here, to finished goods, also an inventory account. And finished goods, that's when the goods are actually finished and ready for sale. That's actually when those goods can be sold, and that's when we convert that to accounts receivable, and then finally into cash. So this operating cycle that I just detailed down here, you don't need that for this class. That's what we'll be focusing on in accounting for. We'll be focusing on manufacturing companies. But just to give you an idea, instead of just buying inventory and converting that to cash through the cycle, we actually have to go through this entire process to actually take these raw materials, take labor, take this manufacturing overhead, use that to work on the product. That's the work in process. Once we put those costs to use, they are put into work in process, and then once we actually finish the goods, they're moved to finished goods, which raw materials, work in process, and finished goods are all inventory accounts that you'll learn about in accounting for. But those are all the extra points that are added into this operating cycle for us to go to converting that inventory into actual cash at the end of the day. So what are some examples of manufacturers that you might have heard of? Some examples would be General Motors, Boeing Aircraft, IBM, Dell, you name it. Any company that makes its own products that it's selling is considered a manufacturer. Our main focus, again, will be on retailers, merchandisers, but all the main basic concepts that we'll be learning about for merchandisers you can apply that to manufacturers as well. Now, one other thing to mention, because we want to know what this is what is a wholesaler? Now, a wholesaler, they purchase large quantities of product from various manufacturers, and then they sell those products to various retailers. Okay, so they purchase larger quantities of product from various manufacturers, then sell these products to various retailers. So that's how the wholesaler will differ from a manufacturer or retailer. They're kind of in between those two. So the wholesalers will purchase from the manufacturers and then sell to the end retailer, whose purpose is to sell to the end customer at the end of the day. All right. So we've looked at what an income statement would look like, but we've looked at it from the perspective of a service-based business. Now, the income statement, how we set it up and what is included on there, the basics will stay the same, but there's a little bit of a difference between a service company and a merchandiser. So let's look at the differences here. So you have a service company and then you have a merchandiser. So how would the income statement look different? So I'm just going to do a basics setup here. So remember, your service company, we've talked about revenues, whatever that amount is, minus your expenses. That gives you your net income. And again, this is a very summarized version, but that gives you your net income. With the merchandiser, often you won't see the word revenues used, although it's the same idea. Instead of using revenues, if you're selling things, the revenue account you'll often see pop up as sales instead, but it's the same idea. Sales or sales revenue, all the same thing. But with a merchandiser, you start out with sales, and then you first list, instead of listing all your expenses at once, you list a very specific expense first. That expense is your cost of goods sold. So you subtract that out first. Your sales minus your cost of goods sold gives you an intermediate line item titled gross margin. Your gross margin is your sales minus your cost of goods sold. Okay? And then after you have your gross margin, that's when you list all of your other expenses. I'm just doing it as a overall other expenses. Once you subtract out your other expenses, then you get to your net income. So the main difference here is that with a merchandiser, we list cost of goods sold as a separate expense. Instead of listing it along with all the other expenses, first we do sales minus cost of goods sold, and that gives us our gross margin. So reading this chapter and now coming to the video, you've heard probably this cost of goods sold phrase come up a lot. Cost of goods sold. This is a specific expense account. Okay, cost of goods sold, although it doesn't have the word expense in it, has the word cost in it, which has the same effect. So cost of goods sold, it's an expense account that goes on the income statement. And it simply refers to the cost of acquiring the inventory that was sold during the period. Okay, so cost of goods sold, when you look at that account balance, it's simply the balance of, or the total cost of the inventory that you ended up selling. Because when you make a sale, you record the sale itself, which we'll look at in a couple of moments. But when you make a sale, we've already learned how to record the sale itself. But what we haven't yet looked at is the cost of that sale. If you're actually selling goods, we're specifically looking at the cost of the goods that we sold. So a second entry needs to be made to actually record the cost of the things that you sold. Now, one thing that we didn't go into detail for a service company, often you can record specific costs related to the service provided. So sometimes with certain public companies, if they're a service-based business, instead of seeing cost of goods sold, you'll see cost of providing a service or cost of services provided. That's a common account that you might see pop up. All that means is instead of having expenses listed in a long list like we have over here, they might keep specific track of specific costs related to specific service jobs and just lump that into a specific expense account called cost of providing services or cost of services provided. But we're focusing here on cost of goods sold, which refers to the cost of the merchandise that a company sells. Okay, so now let's just remind ourselves what gross margin is. Gross margin, this involves cost of goods sold. Oops, let's highlight that. Gross margin is simply defined as your total sales minus the cost of goods sold. So it's how much is left over from your sales after subtracting out the cost of the sale. Okay, so again, cost of goods sold, we said it's the cost of the merchandise you sell, but another way of referring to it, it's also when you have sales, those sales cost you something. In this case, what those sales cost you is the inventory that you purchased. So cost of goods sold is the cost of those sales that you've made. Okay. Now, operating expenses, cost of goods sold is technically considered an operating expense, but we don't lump it in with operating expenses because operating expenses are categorized separately on the income statement. Operating expenses, these are expenses other than cost of goods sold, like salaries expense, rent expense, depreciation expense, all those kinds of expenses we've come across. So expenses other than cost of goods sold that are incurred to support operations. Another thing to mention is they are directly related slash involved in operations. So think of insurance expense. That's another operating expense, for example. Most companies out there, depends on what kind of company it is, but most companies can't operate without having insurance. It's a necessity. So because insurance is necessary for them to even operate, it's considered an operating expense because it not only supports operations, but it's directly involved with operations. Just like depreciation or rent or salaries expense, even supplies expense, you name it. So operating expenses are those expenses other than cost of goods sold that are directly related or involved with operations. Now, what about non-operating expenses? So if you know the definition to operating expenses, you can figure out the definition to non-operating expenses. Non-operating expenses, and actually, let's be a little bit more general here because it's not just expenses. Let's just in general refer to this as non-operating items. Let's do that. That's a better overall definition here. Non-operating items, whether it's expenses or revenue, non-operating items, that would be expenses / revenues not directly related to operations. So, as an example, think interest expense or dividend income. Those are two examples. So what is dividend income? Well, remember, even though you might be a public company and you sell shares and you pay dividends to your shareholders, there's no rule against a company actually buying shares of another company. So if a company buys shares in another company and they receive dividends as a shareholder, that is considered dividend income to the company. But those dividends, that income from dividends, is not part of our normal operations. That's not why you're in business. It's just an extra source of income that's not really directly related to what the company does to make money. So for that reason, dividend income wouldn't be listed along with regular sales and revenue. It would be listed in the income statement under the category of non-operating items. Same with interest expense. It's not part of operations. It involves the cost of borrowing money from the bank or from another entity. So interest expense is not considered an operating item. Most often it's just included under non-operating items. So other things that you might see under the non-operating items list would be gains or losses from investments. So whether it's a gain or a loss, or gains or losses from foreign currency exchanges. So the foreign currency exchanges, any gains or losses from that is beyond the scope of this class. You'll come across that in an advanced accounting class, but we will touch on a little bit of gains and losses from investments in Chapter 7. We'll see a little bit about that. But the most important thing to take away from here is as we learn more about the income statement, we can set it up with more detail. More importantly, if you're a merchandiser, we need to make sure to list cost of goods sold separately. And then we have a category where we list operating expenses first. Once you list those operating expenses, you can find not your net income, but first your operating income. And then you list any non-operating items. And that will either be pluses or minuses depending on if it's a gain or a loss from something, or if it's interest expense or dividend income. And after you list all of your non-operating items, that's when you will be able to list your overall net income, your bottom line. Okay. So far we've talked about the ledger. We've talked about it including the T accounts, all of those accounts that a company works with. So really, those are called your control accounts. So another word for control accounts, a control account, it's just simply your general ledger accounts. Those accounts that we've already come across, your general ledger accounts. And these are used to prepare financial statements. So they are just the ending balances in all of those main accounts that we have. But in this chapter, we learn about one other thing. Oops. And we learn about subsidiary ledgers. Subsidiary ledgers, they contain information about specific accounts in the ledger, like accounts receivable or accounts payable. Okay, so again, your subsidiary ledgers contain information about specific accounts in the general ledger. So an example of this would be your accounts receivable or your accounts payable. And merchandisers will always have a subsidiary ledger for both of these. So let's talk about that. Let's go into a little bit more detail. So as an example, let's say you have 50 customers. That's quite a bit. Some companies have a lot more than that, but let's say you have 50 customers. The accounts receivable subsidiary ledger, this will include records for each of those customers individually. So when you look at the accounts receivable subsidiary ledger, you can look at each customer individually and see how much that specific customer still owes you. It looks at each customer's individual balance. Now, each customer's individual balance, their own balance that is listed in the subsidiary ledger, all of those individual balances added together is what makes up the overall balance in accounts receivable that you see in the general ledger. And I'll say that again. All of the individual customer accounts receivable balances, what each customer owes you on their own, right? Because each customer is separate. So all of the individual customer accounts receivable balances add up to the accounts receivable balance you see in the general ledger. So far we've talked about, hey, this is the balance in accounts receivable according to my adjusted trial balance. That is a sum or a total balance of all of the customers that company has. But we use a subsidiary ledger to keep track of each customer's specific accounts receivable balance to know what any given customer owes us at any given point in time. Now, some merchandisers will also maintain an inventory subsidiary ledger. An inventory subsidiary ledger. So all this means is if a merchandiser is keeping an inventory subsidiary ledger, all that means is they are creating a separate inventory account for each item they sell. And so they're creating a separate inventory account for each item, each kind of item they sell. So for example, if a company sells chairs, tables, and even, TV stands, whatever it is, there will be a specific inventory account for each kind of inventory item to keep track of each kind of item. And that makes sense because some merchandisers have thousands of different types of inventory. A large department store, for example, they might have thousands of inventory accounts. But we use then each of those separate accounts to keep track of every individual category of item. Because we don't want to, in that case especially, dump everything into just a general inventory account. How would you ever know how much you have of each item, what each item costs you, and so on and so forth? Because with the inventory subsidiary ledger, if you have separate inventory accounts, each account then will track the quantity of the product that you have, the cost of all the units that you've purchased, because in Chapter 8 we'll see that we don't necessarily always pay the same amount for a product depending on when we buy, how much we buy. Sometimes inventory might be more expensive or cheaper than it was before. So this separate inventory account for each kind of inventory will keep track of the quantity of the product, the cost of all the units purchased, costs and all of the units that you've sold, and how much is still in stock. So when you look at the inventory account for a specific kind of item, you can see, okay, this is how much we've sold so far. This is how much we have in stock. This is how much we paid for the units that were added to this inventory account for the period, so on and so forth. So those are some important concepts and terms for this chapter. And just keep in mind, we're going to do chapter 8 after this chapter because they tend to go really well together. We'll do chapter 7 after chapter 8. So for a merchandiser, we have to look at inventory cost flow because there's some different kinds of entries that we'll come across in this chapter. So inventory cost flow is an important topic. So when inventory is purchased, so purchase of inventory, when that happens, it is recorded as an asset on the balance sheet. So when we purchase inventory, it is recorded as an asset on the balance sheet. So and again, we'll be going into a little bit more detail. So this might be slightly modified depending on the kind of cost system we're looking at, which you'll see what I'm talking about in a couple of moments. But in general, for most companies, when they purchase inventory, they record it as an asset on the balance sheet immediately. So this will involve a debit to your asset account called inventory. It's a new asset we're learning about. Debit to inventory, increase that asset account, and then you will credit either accounts payable or cash as the other half of that purchase. Now, when inventory is sold, what would that look like? It needs to go in the books. It's an important transaction. When inventory is sold, its cost is moved to the income statement. And it is moved to the income statement as cost of goods sold. And remember, cost of goods sold is an expense account. So what would this entry look like? It would involve a debit to cost of goods sold and a credit to inventory. And why would that be? Well, again, when you sell inventory, that inventory is no longer there, so you have to decrease that inventory account by crediting it. And then you have to debit cost of goods sold to show that increase to the cost of what you just sold. Because we need to know what cost of goods sold is to know how profitable a specific transaction is. So essentially, when you sell inventory, you're converting it from inventory into cost of goods sold. So it goes from being on the balance sheet to on the income statement when you sell inventory. Now, there are two approaches to merchandise inventories. So if you're a merchandiser, there's two approaches to just your overall merchandising accounting system, keeping track of those cost flows. Okay, so there's two main approaches. And by reading, you will have seen that those two approaches, you can, as a merchandiser, you can choose from two cost systems. You can, or inventory systems rather. So one is the perpetual inventory system, and the other is the periodic inventory system. So you can choose between these two. The perpetual inventory system is the most commonly used just because of the ease of implementing a system like that with the current technology we have, with also the affordability of certain accounting software systems out there. But the periodic system is still in use. But we'll look at the perpetual system to start off with. So we'll start with the perpetual inventory system. And again, this is the most commonly used system when it comes to merchandising. So the perpetual inventory system. So like I briefly mentioned before, due to advances in technology, that has allowed this kind of system to become really cost effective and relatively easy to use because of the accessibility of those various computerized accounting systems. Think of QuickBooks, for example. Even if you're a really small business, you can find a relatively affordable QuickBooks software system that you can put on your computer to keep track of all of your transactions and to keep good records. You don't necessarily need to, as a small business, purchase a really robust and expensive accounting system as would be necessary for a company like Google or Apple. So although you're a small business, you can still apply the concepts of accrual accounting and use the perpetual inventory system because you have access to relatively more affordable computerized accounting systems. Again, most companies will use the perpetual inventory system. The periodic system is still in use, but most companies will use the perpetual inventory system. Okay, so what makes the perpetual inventory system different from the periodic system? So let's look at first some characteristics of the perpetual system. So with the perpetual system, and I'll write this out one by one because you'll want me to write this out actually. Transactions are recorded immediately as they occur. Because if you have a computerized system, you can record these transactions immediately as they occur. So this allows records to be perpetually kept up to date. Let me add the word records in there. Records are then perpetually kept up to date because of this fact. So with a periodic system, it's a manual accounting system in that case. So you might not be able to record the transactions immediately. Your accountant or you individually as the owner will probably end up recording those transactions when you get a chance. But with a computerized accounting system, it's a lot easier to record those transactions right away. Now, this is really what's really characteristic of a perpetual inventory system. So when merchandise is sold, 2 entries are required. That's really important. 2 entries are required. The first entry is actually just recording the sale. The entry where we've done this a lot before, where you recognize revenue. Just recording the sale, recording that revenue. So recognize revenue earned based on the sales price. But it doesn't stop there. Once you record the sale, you have to record the cost of the sale. So they go hand in hand. So the second entry is where you recognize the cost of goods sold and where you reduce inventory. So first, when you record the sale, that's when you debit either cash or accounts receivable and you credit sales or sales revenue. The second entry is where you actually now have to record the cost of that sale and the reduction in your inventory. So you would have to debit cost of goods sold because it's an expense, and you would have to credit inventory in that situation. And with the perpetual inventory system, we use the account called inventory from the get-go. So we can look at some examples here. So let's assume you purchased 10 computer monitors. And again, I'm pulling these numbers from these examples from the PowerPoint so you have familiar numbers to look back on. So I purchased 10, let's assume we purchased 10 computer monitors on account from Akawa Wholesale The monitors cost $600 each for $6,000 total. Payment is due in 30 days. All right, so let's look at some examples of how we would apply the concepts of a perpetual inventory system to some transactions. So when we make this purchase, the $6,000 purchase, what would that look like? Well, we bought inventory because we're selling these monitors for resale. So if you purchased inventory, that's an asset. So your assets have to go up. And we bought it on account because the payment is due in 30 days. So we also have accounts payable or a liability going up. So to record this entry, you would debit your inventory account. We would debit inventory for $6,000, and we would credit accounts payable for $6,000 as well. So this is what the entry looks like for just the purchase of inventory to start out with. So that's the entry that you will record when you purchase inventory. Okay, so let's take that a bit further and see what it looked like once you eventually make a sale. All right, so I went ahead and wrote down the description of the transaction ahead of time. So we bought some inventory, right, $6,000 worth of monitors, but now on September 7th, let's assume that we sold 2 monitors for $1,000 each on account to a company called RJ Travel Agency. So remember, we said as part of a perpetual inventory system, when you make a sale, you not only have to record the sale, but in a separate entry, you have to record the cost of the sale. So let's see what that would look like. So we have to record the sale first. So the sale entry is separate. So to record the sale, we've done this a lot. Remember, we've done this before. The sale, in this case, is 2 monitors at $1,000 each that you're selling them. So the total amount of the sale is $2,000. So how do we record a sale? How have we learned to record a sale before? And again, we sold this on account to the company. So instead of debiting cash, we're going to have to debit accounts receivable. So we're debit accounts receivable for $2,000, and we will credit sales. So sales is a revenue account. This might come up as sales revenue or revenue depending on the company, but we're going to use sales since it's a merchandiser. So we'll credit sales. Sales is revenue. Works the same, just a different name when it's a merchandiser. So you debit accounts receivable, and then we credit sales. But we can't stop there under the perpetual inventory system. You have to record the sale, but then you have to record the cost of the sale as well. Otherwise, we're not recording that reduction in inventory or the increase in the cost of goods sold. So first we ask ourselves, what did those 2 monitors cost us? Remember, how much did you buy them for initially? You paid $600 each for those monitors. You sold them for $1,000 each, but they cost you $600 each. So you're selling 2 monitors, and they each cost you $600. So the total cost of those 2 monitors we sold is $1,200. Because remember, each of those monitors is in the inventory account at $600 each. So now that we sold 2 of them, we have to take $1,200 out of the inventory account. So to record the cost of the sale now, we are going to debit cost of goods sold. And debit that account for $1,200, and then we will credit our inventory account for $1,200 as well. So we've recorded the sale and also the cost of the sale on September 7th. Okay. So let's take a look at some later transactions. All right, so the next transaction is, remember, we initially, in order to be able to sell monitors, you have to have purchased them initially, right, from a wholesaler. So remember, we purchased 10 monitors for $6,000 total from Okawa Wholesale. And that, I forgot to put the date on that it was September 1. Okay, so now fast forward to October 1. Now we're paying Okawa Wholesale the $6,000 that we owe them from that initial purchase. So how we've seen this before as well. What does it look like when you pay off a payable? Well, we debit the payable. We debit that accounts payable, that liability, to reverse it. So here we're going to debit accounts payable for $6,000, and we will credit cash because that's the only way that you can satisfy or pay off a payable is with cash. And again, we've seen an entry like this before. We know how to do this. Now it's just within context from the perspective of a merchandiser. So when this company now is paying Akawa what they owe them, we debit accounts payable for $6,000 and credit cash. All right, now that we've recorded paying off that payable, now we fast forward to October 7th. It says that we collected $2,000 from RJ Agency for their purchase on September 7th. Okay, so we collected $2,000, the $2,000 accounts receivable from RJ Travel Agency for their purchase on September 7th. And remember, when it says on September 7th when we sold those 2 monitors, right? We were debited accounts receivable because they didn't pay us right away. So now on October 7th, all that's happening a month later is that they're paying that $2,000 that they owe us. So what does that look like when a customer pays you what they owe you? We are just reversing accounts receivable in this case. So you're collecting $2,000. So that's a debit to cash. We'll debit cash for $2,000. And we will credit accounts receivable for $2,000 as well to reverse that receivable. Now that receivable for that customer has nothing left. Okay, so that's some of those basic entries that involve purchase of inventory, making a sale, which involves two entries, the entry recording the sale and the entry recording the cost of the sale, and what it looks like, which we've seen before, to pay off a payable, what you owe your supplier, and then receiving money that your customer owes you that we just did here. All right. Taking a physical inventory. So this applies to both systems, but we're looking still from the perspective of a merchandiser using a perpetual inventory system. So taking a physical inventory. So a physical inventory, that means going and counting actually how much inventory you have on hand. This is done at least once a year, usually at the end of the year. Okay? And this is done to ensure the accuracy of the perpetual inventory records. Okay, so although we're constantly updating inventory as we have changes to inventory with a perpetual system, it's constantly being updated, we still have to do a physical count at least once a year, usually at the end, to see how accurate are our records. Because, why do we have to do this? Because over time, a thing called inventory shrinkage occurs. Inventory shrinkage, it's considered a normal cost of doing business in most cases. It's just part of life. If you're a merchandiser, inventory shrinkage occurs. And inventory shrinkage is basically, it refers to unrecorded decreases in inventory due to things like breakage, if your stuff breaks, spoilage, if you're working with perishable items, if it spoils, theft, and etc. So it's any time inventory goes missing or inventory is deemed unusable, then that is referred to as inventory shrinkage. And we'll know there's shrinkage when we go and count the physical inventory. So you compare what you counted to what is on the books. If there's a difference between those two amounts, then inventory shrinkage has occurred. Okay, and when there is inventory shrinkage, inventory is adjusted to reflect any shrinkage that has occurred. Okay, so if there is actually shrinkage, if they actually go in and account and they find that there is inventory shrinkage present, then Cost of goods sold, you treat that missing inventory or whatever happened to that inventory, the inventory is treated as if it was sold. So what is that entry to record the adjustment to inventory when you sell it? That's the same inventory or the same entry we use to record inventory shrinkage. So if there is shrinkage present, you increase cost of goods sold with a debit and you decrease inventory on the books, because remember there's inventory missing or something happened to it. Then if there's a physical decrease to inventory, we have to decrease that on the books, and we have to decrease that with a credit. So this would look simply like a debit to cost of goods sold for some amount, whatever the shrinkage amount is, and then you will go and credit or decrease inventory for whatever the shrinkage amount is. Now, this method only applies if the shrinkage amount is reasonable, or in other words, immaterial. Okay, same thing. So if the shrinkage amount is considered reasonable / immaterial, it's considered a normal cost of doing business. So you just add it, you increase cost of goods sold, you just add it to cost of goods sold, and you do this entry. You debit cost of goods sold, and you will credit inventory. However, if the inventory shrinkage is considered material for whatever reason, if there's a large theft, for example, there's a bunch of inventory that was stolen, for example, then it's not considered a normal cost of doing business. In that case, instead of debiting cost of goods sold, you will debit a specific shrinkage loss account. So if it's an unreasonable amount, if it's a material amount of inventory shrinkage, you will debit an account. For example, a company might just call it shrinkage loss. You will debit shrinkage loss, and then you will credit inventory instead. In that case, if it's so large, if it's a material amount, then a company will often want to keep track of it separately in its own account instead of just blending it in with the regular cost of goods sold. So if you're working in a perpetual system, you still have closing entries, just like for a service business. Your closing entries are the same. Surprise, surprise. So at least we can use what we learned in Chapter 5 moving forward. The closing entries are the same, exactly the same. You will close revenues to income summary. You will close expenses, including cost of goods sold, to income summary, because remember, cost of goods sold is an expense. You will close income summary to retain earnings, and then you will close dividends to retain earnings. No difference there. And really, those don't look different under a periodic system. We just learned about a couple of extra entries in the periodic system when it comes to that closing process. Okay, up next is the periodic inventory system. How is this going to look different? There's a lot of similarities, but there's also some differences with the two types of inventory systems and whatever a company decides to use. Okay, so with a periodic, and if I accidentally switch out periodic and perpetual throughout while I'm doing this, I apologize. But now we're talking about a periodic inventory system and seeing how it differs from a perpetual system. So most often, if this is the kind of system in use, it's being used by small businesses that use manual accounting systems where they don't have a computerized system. So with the periodic system, there's no effort made to keep up-to-date records of inventory or cost of goods sold. So remember, we said with the periodic system, you record transactions when you get to them because it's with this kind of system, the accounting is done manually. So for that reason, specifically inventory and cost of goods sold, we don't update these as we go. like we see with the perpetual inventory system. We're constantly updating those when there's a transaction. With the periodic system, you're not updating these constantly. Instead, inventory and cost of goods sold, it's not updated constantly, but instead, inventory and cost of goods sold, these amounts are determined periodically. And this is done usually at the end of the year. So let's clarify. So with a perpetual system, we're constantly updating inventory and cost of goods sold. But with the periodic system, we don't have that any kind of fancy software system doing that for us, where we're able to do that really quickly. So instead, with the periodic inventory system, we ignore inventory and cost of goods sold until the end of the year. It's only at the end of the year where we finally determine these two amounts and update them so that we can set up our balance sheet and set up our income statement accurately. But the main difference here is we don't know what these total amounts are until the end of the year, and that's when we update them. So another difference, when inventory is purchased. So what happened when we purchased inventory under a perpetual system? Well, remember, when we purchased inventory under a perpetual system, what account did you debit? You debited the account called inventory, right? But with a periodic system, remember we said we don't update inventory as we go. That's one key difference. We don't update inventory. So in a periodic system, when you purchase inventory, you don't increase the account called inventory. Instead, you increase an account called purchases. So when inventory is purchased under a periodic system, you don't increase an inventory account. Instead, you increase the purchases account, it's a temporary account. This is an account that is also closed that we'll learn about. So instead, you increase purchases. How do you do this when you buy inventory? So when you purchase inventory, you increase an account called purchases with a debit, and then you decrease cash, or you increase accounts payable, right? So you'll either end up crediting cash or crediting accounts payable. So what would this look like? For example, then you'll debit purchases for whatever amount that you're buying, whatever you paid for your inventory, and then you'll credit cash or accounts payable for that same amount. So that's what this entry would look like with a periodic system. What's the only difference? The only difference is what you debit when you buy inventory. When you buy inventory under a periodic system, you debit purchases. But when you purchase inventory under a perpetual system, instead of debiting a temporary account called purchases, you debit inventory right out of the gate. Okay? So far we see that inventory and cost of goods sold isn't updated constantly. We do it at the end of the year. And with a periodic system, we buy inventory, we debit an account called purchases, not inventory. And what else? Well, we've looked at when inventory is purchased, but what about when inventory is sold? What's the difference? Well, when inventory is sold, just like with a perpetual system, when inventory is sold, an entry is made to record the sale. We know how to do that. That doesn't change. You still make an entry to record the sale. Just like with the perpetual system, when you make a sale, you have to record that sale. However, with a perpetual system, remember we said you have that second entry that goes along with it to record the cost of the sale. But with a periodic system, there is no second entry. Okay, there is no entry to record the decrease to inventory and the increase to cost of goods sold. Why? Well, we just said that under a periodic system, those two accounts aren't updated constantly. We deal with that at the end. So because of that, with the periodic system, when you make a sale, you just record the sale and you don't record the cost of the sale with this kind of system. But with a perpetual system, you do have to have both of those entries there. So what's the bottom line here? Under a periodic system, inventory and cost of goods sold are not updated as transactions occur. Instead, we update that at the end of the year. So we also do a physical count with a periodic system. So when you go in at the end of the year and you make a physical count of your inventory, when you go and see what's there, that physical count, that is what determines the amount of inventory to record on the balance sheet. What's different with this is that the physical count is what we use to determine what the balance of inventory is to go on the balance sheet. With the perpetual system, the physical count is what we do just to double check to see what is there versus what we think is there, according to the books, right, and to find shrinkage. But with a periodic system, the physical count is what we use to determine actually, okay, what inventory do we need to record on the balance sheet now at the end of the year? And then that's how we find inventory at the end of the year. And cost of goods sold at the end of the year, this is determined by a short computation that we're going to look at in a second here. So we have a short computation that we do to find that. And we'll look at that in a second. But just let's see what a specific transaction would look like. Let's look at a purchase transaction under a periodic system. So let's assume that we're looking at Wagner Company and they purchase merchandise in the amount of $2,000 on account from a company called Inkjet. So let's assume this is a periodic system. So when we purchase this inventory, this merchandise, instead of debiting inventory, if it's a periodic system, we debit an account called purchases instead. We'll debit purchases for $2,000. And because we purchased it on account, we're not going to credit cash, but we will credit accounts payable for $2,000. If this were a perpetual inventory system, instead, we would simply just debit inventory instead of purchases. But since this is a periodic system, we will debit purchases in this system. So let's look at that computation for cost of goods sold that I mentioned. So here again, we're looking at Wagner Company. And again, I pulled this from the PowerPoint. Their accounting records show that their beginning inventory that they started the year out with was $14,000. Then the purchases they made during the year was $130,000, and then they ended the year with, again, physical count, they ended the year with $12,000 on December 31st. So the question is, how do they know, if they're not updating these inventory counts throughout the year, how do they know what the beginning inventory is and what the ending inventory is? And the answer would be just through physical count, because we know that at the end of the year, under a periodic system, a physical inventory count is done, and that's how they determine what's left over in inventory. Well, then how would they know what they started the year with? Well, remember, last year's ending inventory becomes this year's beginning inventory. So if they counted last year's inventory at the end, whatever inventory they ended with is what we start with. So what we're going to see here is how to do the cost of goods sold calculation under a periodic system here for Wagner Company. So cost of goods sold computation. Because remember, inventory, we don't compute that. We can just go do a physical count and we know what the ending inventory is like here. But the cost of goods sold, that needs to be computed. And that computation is done as follows under a periodic system. So you start with your beginning inventory. That is the $14,000. You add your purchases. We know that's $130,000. And when you add beginning inventory and purchases together, we can do a subtotal of that before I move on, and we'll call this cost of goods available for sale. So the cost of goods we have available for sale, that's $144,000. And then you subtract your ending inventory, and they tell us the ending inventory is $12,000. So cost of goods available for sale minus the ending inventory, that gives you your cost of goods sold for the year. And 144 minus 12, that gives me $132,000 for my cost of goods sold. So that's the computation for cost of goods sold for a periodic inventory system. So again, the inventory I start with plus the additional inventory I buy, that is the cost of the goods I have available to sell. So looking at the cost of goods I have available to sell minus what I'm left with, that has to be the difference between what I had available to sell and what I had left over must be what I actually sold, the cost of the goods sold. So again, let's just remind ourselves here. The inventory account is not updated throughout the year. So up until this point, the inventory account still has that $14,000 in it. It hasn't been updated throughout the year. But we now know what the new inventory account balance is actually $12,000. But the thing is, the cost of goods sold account, on the other hand, it has a zero balance because last year we closed out cost of goods sold just like any other expense. And if we don't add to that account, if that account isn't updated throughout the year, it's still sitting at zero in a periodic system until this point in the period or the year. Once you do the computation for your cost of goods sold, it doesn't stop there because this is, okay, if this is our cost of goods sold, we actually need to update the books for that. We actually need, at this point, once we do the computation, we need to create a cost of goods sold account, or at least establish a balance in that cost of goods sold account. And why? I'll reiterate again, why do we do this? Because remember, throughout the year, inventory and cost of goods sold is not adjusted throughout the year, updated. Cost of goods sold is an expense that is closed like all the other expenses at year end. So if we haven't yet updated cost of goods sold, it still has a zero balance. So how do we create this cost of goods sold account? And this computation, the way we've laid it out here is actually very helpful to do the following entries. So the first thing you do, because we ask ourselves, okay, inventory, it has a balance, but it still has the old balance, the beginning inventory for the year, the ending inventory from last year. So the first thing you want to do is you want to remove the old balance in inventory with a credit, and you want to close the purchases account with a credit, and then taking that together, because there's two credits, then we debit cost of goods sold for the amount of cost of goods available for sale for the year. Because remember, because we said remove the old balance or your beginning, that's your beginning balance. We're going to remove the beginning balance of inventory out of that account to clear it out so we can put the new balance in there. And we're going to close the purchases account. Remember, your beginning inventory plus your purchases, that equals cost of goods available for sale. So these two credits, the offsetting debit is going to be to cost of goods sold, and the total amount will actually come out to be your cost of goods available for sale. So let's illustrate that. Let's see if we can zoom out slightly here. Okay, so let's do that entry. So you're going to debit cost of goods sold, and I'll leave out the amount in a second just to show you how you can build this entry if you don't know that yet. But first thing you want to do, essentially, is remove whatever the old balance in inventory. And the old balance is that $14,000. So we're going to credit inventory for $14,000. And we're going to close our purchases account. Because remember, anytime you buy more inventory under a periodic system, you debit purchases. So to clear out that account, to close it, we're going to credit purchases. And the total purchases we've made throughout the year is $130,000. So 130 plus 14, that's $144,000. Beginning inventory plus purchases is my cost of goods available for sale. So you're actually going to end up then debiting cost of goods sold for the cost of goods available for sale amount. So that's the first entry involved with creating that cost of goods sold account and updating inventory. Because really what we're doing here, there's a set of two entries. We're not only creating a cost of goods sold account, but we're updating cost of goods sold to its proper balance, and we're updating the inventory account. So now we've closed purchases. What's happening here? We've closed the account called purchases. We've removed the old inventory balance, or the beginning inventory balance, and prepping it to be updated with the new amount. And we've created a cost of goods sold account, or in other words, established a balance in there by adding in or debiting the account for the cost of goods sold amount. So at this point, after the single entry, cost of goods sold now has a debit balance of $144,000 in it. But we know this is not accurate. This is not what cost of goods sold actually was for the year, because didn't we do the calculation for this, right? We calculated out that cost of goods sold for the year is $132,000 actually. It's not the $144,000 of cost of goods available for sale, it's $132,000. Now, in the second series of the two entries, because there's two entries involved at the end of the year for a periodic system before you do all the other closing entries, now in the second entry, we're going to correct this cost of goods sold balance and bring it down to $132,000. So the second entry, it does two things. The second entry will correct the cost of goods sold balance, and it's going to update inventory to what it actually needs to be. Because currently, not only does cost of goods sold have an incorrect balance in it, but a balance nonetheless, but currently inventory has nothing in it. Because remember, previously it had $12,000 in it, right? That's the beginning inventory that we had, and now we ended up, or sorry, not 12,000, it had 14,000. Let's take a look here. Remember, our beginning inventory was $14,000. So that's what your inventory account looked like. But now to prep it for the new balance, in that first entry, we ended up crediting inventory. So you have nothing. That zeroes out to nothing, right? So now, after that first entry, there's nothing left in your inventory account. But we actually have something left. Remember, we did an end of the year count. We did a physical count at the end of the year, and we found ending inventory to be $12,000. So we want to put $12,000 into this account, first of all. And we want to update cost of goods sold to the correct amount, to the $132,000. So what would that look like? So you're going to debit inventory, because since inventory now sits at zero, we want to put into that account what needs to be there. And we actually have $12,000 left in inventory. So we're going to debit inventory for $12,000 to put its correct balance in there, update inventory. And then you're going to credit cost of goods sold for $12,000 as well. What this does is has a purpose for both accounts. So what that second entry does here is now it updates inventory to its actual balance. We debited inventory. And now by crediting cost of goods sold for $12,000 as well, now we've actually established a correct balance in this account. $144,000 minus $12,000 leaves me with a debit balance and cost of goods sold of $132,000 now. And that's actually what we were going for, because that matches up with our calculation that we made. So these two entries that you do at the end of the year under a periodic system before your other closing entries, it's probably the least intuitive out of all the entries that you've seen up until this point, in my opinion. So these are the least intuitive entries, and all that means is that you're going to have to make sure that you practice these entries a couple of times and really just get the structure down, because the only thing that will really change is the numbers from one situation to the next. These are just two kinds of entries that you'll have to learn, especially since they're the least intuitive kinds of entries. This is just the way it's done under a periodic system. All right, so now after we close purchases, create a cost of goods sold balance, and fix the inventory balance, after those entries are completed under the periodic system for a specific company, then you can close all other accounts at the end of, since it's the end of the year, close all other accounts like you normally would. So what would that look like? Well, that means you close your revenues to where? You close your revenues or your sales accounts to income summary. You close your expenses to income summary. Then we close income summary. Again, this is from chapter 5. Then we close income summary to retained earnings. And then we close dividends to retained earnings. All right, now to just sum up, because we've now looked at both the periodic and the perpetual inventory systems, and there's different characteristics and how they're different. Let's just discuss what would cause you maybe to pick one over the other for a specific kind of business, and that will end this video, and in a second video we'll go on to the other portion of the chapter. But let's just look at some things that might point you to one over the other. So a perpetual system. Usually if you're a large company with professional management, that's a pretty good motivator to use a perpetual inventory system. But if you're a small business, small business run by the owner, then you might be more inclined to use a periodic system just because of the size of your business. There's less accounting involved because you're going to have less transactions. So maybe you just want to stick with the periodic system because it's simple and you don't need to invest in any software. So that could be one of your motivations. Another reason you might want to go with a perpetual system is, what if your management or your employees want information about those items in your inventory and specific quantities of specific products that you're selling? If they want to be able to go to the computer and immediately look up, oh yes, we have 12 units of product A still in stock. If that's a need of your business, you're probably going to want to use a perpetual system. Because under a periodic system, you're not necessarily going to be updating those inventory amounts with every transaction, where with a perpetual system, you have the means to do so. So if there is a need to know what is in stock or any info about items and inventory. And I'm just summarizing that there. So with a periodic system, though, if the accounting records of your inventories and specific product sales, it's not needed for your day-to-day operations, then you might just want to stick with the periodic system. If you or your employees or management doesn't necessarily need to know the specifics about the items in inventory, or they don't need to be able to look those things up necessarily through a computer system or a software system, maybe a periodic system might make more sense. So in this case, let's go ahead and say specific info / records of inventories, sales not needed on daily basis. All right, what would be another motivation for using a perpetual system? So if you have items in inventory that have a high per unit cost, you might want to use a perpetual system. Items in inventory with high per unit cost. Because if you think, for example, of, let's say you are a retailer that sells electronics. A lot of those electronics might be very expensive to have in stock. In that case, you really want to have accurate, up-to-date records of those kinds of items. In that case, a perpetual system might work better to have really up-to-date info on your inventory and really what's there. On the other hand, though, if you have inventory with many different kinds of low-cost items, so inventory includes low-cost items, you might not be so inclined, or might feel that you might not need to have constant up-to-date info on your inventory. For example, what if you are in the business of, let's say you sell various stationery items, pens, pencils, or if you specialize in selling certain hardware items that you buy in very high quantities, but the per unit cost itself might be very low, like a screw, for example. You buy a lot at a time, but the screw itself on a per unit basis might not cost much. If you're a mom and pop shop or a really small business, having that updated with every single transaction might not be as necessary, or you might not see a need for that. Just depends on the company or the owner. But having a bunch of low-cost items in inventory might be a motivation to stick with the periodic system versus a perpetual system. Another motivation for a perpetual system, if you have low volume of sales transactions, or a computerized accounting system. So either or both. If you don't have a lot of sales transactions to record, or if you already have a computerized accounting system, a perpetual system just makes sense. On the other hand, with a periodic system, if you have high volume of sales transactions and you have a manual accounting system, a periodic inventory system might make more sense, because if you have high volumes of sales transactions, it'll become more time-consuming for every sales transaction to go and record the cost of that sale, like we do with a perpetual system. So if you have a manual accounting system, it becomes a lot more difficult to do that second entry, to do that updating to the records for every sales transaction, because especially if it's a small business, you just might not have the manpower or the hours to keep up with that accounting if you have a manual accounting system and lots of sales transactions that you have to keep track of. However, if you have a computerized system already, it's a lot easier to keep those records up to date as those transactions happen. Or if you just have a low volume of sales transactions and not necessarily a fancy system, but if you have a low volume of sales transactions, then it's obviously a lot easier to go ahead and immediately do that second part of the accounting for that and also record the cost of the sale. And by the way, this whole table is in the PowerPoint as well if you want to access this table. And another motivation, lastly, for a perpetual inventory system is if your merchandise is stored at multiple locations. In warehouses separate from the sales sites. So that would make more sense. If you have merchandise all over the place, then you probably should be more inclined to stick with a perpetual inventory system, because especially if inventory is everywhere, you want more details on it. Where is everything? How much do I have of everything? Just for inventory management, asset management, and securing those assets. However, if all your merchandise is stored at the sales site, like at your store, let me actually spell that correctly. Merchandise. If all merchandise is stored at the sales site, let's say physically at the store, then at least everything's in one spot, right? Which makes securing and keeping track of those assets, at least visual track of things not just leaving the store, a little bit easier. And if stuff isn't in multiple locations, then you might be less motivated to go with a perpetual inventory system. But in some, these are some motivations to use one system over the other. It's not black and white in terms of, yes or no, this is the right answer for which system to use. But my default would always be perpetual inventory system, just because everything's up to date. You can look everything up in the computer. Every transaction is put into the computer as it happens, especially with your point of sale systems. All of that can be integrated with the accounting system. Nothing wrong with the periodic system. It tends to work better if it's a really small business and it's run by the owner. Maybe that person doesn't have the expertise to record those things on their own, and they just wait for their accountant to help them out, or they just aren't interested in having such up-to-date information because they might not need it, depending on the nature of the business. So it just depends, but that's a little summary table of just some motivations on using one system over the other. So I'm going to stop this video here, and we will continue on in a second video to look at things like credit terms and discounts, the net cost versus gross method when we're recording purchases and sales, and so on and so forth.